Good morning, everybody. Thank you for joining us. Welcome to REI Talk. It's our weekly investment webinar brought to you by Real Estate Investor. And today's webinar is proudly sponsored by Opportunity Private Capital. My name is Neil Peterson. For those who don't know me, I'm the founder and editor-in-chief of Real Estate Investor. And we've been serving the South African residential and commercial real estate industry for over 14 years now, through our digital magazine, online content, live and virtual events, webinars, masterclasses, videos, and podcasts. And we keep you, the investor and the property professional, up to date with the latest inside investor information, education, investment opportunities, and innovations for newbie and savvy property investors. And if you're a home buyer, landlord, developer, property professional, and practitioner in the industry, this is also the place to be. I'm really excited and honored to be your host and moderator for this webinar today. And today our topic is investment returns available in the property sector today. What is it looking like currently? International property investor Dolph Duras used to say when asking what your returns you can get from your real estate investment, well, it depends on many factors: your personal knowledge, your ability and understanding of the property investment sector, your appetite for success, your ability to evaluate various investment options and different sectors. And today there seems to be an uptick of both solicited and unsolicited property investments in advertisements, as well as offers from a number of property agents, brokers, and developers. Now, whether it's direct or indirect in residential, commercial, or offshore, the big question is, are property marketers putting lipstick on pigs? Or are there real bargains in investments out there with above average returns to be had? Yes, there are. There always are bargains. And where are those bargains? What are the objectives? What are your objectives in the transaction? Is it capital growth? Is it cash flow? Is it a quick in and out investment? What is it? There's very different needs for each investor. So we will discuss and we will look at a range of investments from buy to live, buy to let, the rental market, Airbnb, areas that are performing well, peak in affordable housing, alternative property investment. What are the risks? What are the rewards? This is what we're going to be discussing today, and maybe a touch on interest rates as well. So first of all, I'd like to welcome our panel, and I'm going to ask them each to introduce themselves. First of all, I'm going to start off with our proud sponsor, co-founder of Opportunity Private Capital, Nick Morgan. Nick, do you want to introduce yourself to the audience, please?
I think you've just done it, Neil. Thanks very much.
Right, you like it short
Neil,
and sweet.
I do. Neil, thanks very much for having me on. Carlo, nice to see you, and Michelle as well. As Neil said, my name's Nick Morgan. I'm one of the co-founders of Opportunity Private Capital. We're an investment company in Cape Town, and we operate in a very niche residential sector in terms of capital investors. So we have private investors who fund residential projects, and they get pretty attractive returns per annum based on that funding.
Fantastic. It's great having you on the show, Nick. And we look forward to, I think, a robust discussion, because there's a lot happening out there right now. Michelle, will you introduce yourself to the audience, please? And a lot of people know Michelle, very well known in the rental sector. Lovely having you on board, Michelle.
Hi, Neil. Thank you so much. It's fabulous to come and share data with everyone again. Fabulous to be on the panel with Nick and Carlo. So I'm Michelle Dickens. I'm the CEO of TPN Credit Bureau. It is our 21st year birthday anniversary.
Wow.
So we have been doing data analytics in the property market, residential real estate in particular. And today I'm very excited to share the latest trends that we're seeing, the latest analysis that we're seeing through Q1 and Q2 in the year 2021, and coming out of a hard year last year. And I'm pleased to be able to report back some green shoots. So hopefully it's going to be a good session. Thank you.
Wonderful. Well, I mean, you know, after 21 years, they say you get the key to the door. We need to get the champagne out as well, Michelle, you know, so we've got to be in... Absolutely. I think we'll do that after the webinar. Carlo, wonderful having you on board as well. Will you introduce yourself to the audience, please?
Well, thank you so much for hosting me, Neil and Nick. And, you know, I started investing in property here in South Africa in 2003 because I was sick and tired of losing money on the stock exchange. and I decided to stick to it. So, you know, I'm a local and international property investor, and I also have a fantastic passion to share the property journey, you know, with aspiring and growing property investors here in South Africa. And that's why I founded the Property Coach. So today I'm here to share, you know, the good, the bad, and the ugly of what it's like to be in the trenches as a property investor in South Africa in this market. I look forward to it.
Wonderful. We look forward to that discussion as well, Carlo. Lovely having you on board. So we're going to kick off, first of all, with you, Nick. I mean, you've got a very unique product, and I think investors are starting to look at different options. Now, the last year has not been easy. I think it's been tough on a lot of sectors due to the pandemic. What has your experience been like, in particular the investors, Nick? How's that experience been?
Neil, thanks. Yeah, look, I guess that's the question on everyone's mind is how's the last year been? So I think it would be remiss not to at least acknowledge that a lot of sectors have suffered and a lot of people have suffered over the last year. So it's been tricky. For us though, I guess one word might describe it is quite lucky. And it's been a surprisingly good year from our point of view, but I think that needs a bit of embellishment. And I think one thing that people might not understand is for the first time in a long time, certainly in many iterations of good and bad cycles from my point of view, the first time we saw that the big role players in the residential or the property community were actually playing along. And what I mean by that is it's quite rare to have the Reserve Bank lowering interest rates to a point where people were motivated to buy property. Second of all, you had the banks were very motivated to lend to people in order to buy property. And that in itself created a confluence of events that made the property sector pretty robust. And it took us by surprise. I got to admit, you know, we'd been through the financial crisis in 2008 as well. When lockdowns happened, we thought, oh, what is going to come now? And we were very pleasantly surprised by the uptake in the market. So, I mean, to give the guys an example, we were 2/3 of the way through one of our investable projects, and using video technology, having people who were willing to buy property at low interest rates, that just continued going really well. So our investors, to go back to your question, Neil, is our investors were nicely covered because whilst the project was delayed, they still continued earning their interest rates, which were at 18% per annum at that stage. And their capital was, of course, secure because our structure allows for security in terms of the assets in the project. So it was a very surprising year from our point of view. And I'd just like to share, if I can, I'll just show you. There was a slight dip. You can see that's just a sort of 5-year snapshot of the last 5 years' performance on the investment side, and you can see there was a slight dip during Q2 and 3 in 2020, but still well above CPI, and that just goes to show that our investors continue to perform quite nicely despite the rigors of what the economy showed last year. And there's one thing. Sorry, I'm taking up a lot of time, but there's one thing I just want to share is one of the big lessons we learned is that if you don't have someone breathing down your neck, because we're in the development space, if you don't have someone breathing down your neck in terms of performance, like we don't, we were able to be nimble and we're able to get out of these difficult situations with everything intact and unscathed. And I think that's a good lesson to learn from a broader perspective, that given a bit of time, one can get through these things.
Fantastic. Well, you got Carlo that can breathe down your neck because he's the property coach. So, and I'm certainly sure that he actually breathes down the neck of a lot of his students. But Nick, I don't want to leave you there because I think it's important that you set the scene. And I mean, you guys have an investment model which private investors get very good returns, and they participate the funding of residential developments. Can you maybe just take us through it? Because I think it's very important, to set the scene in terms of the different types of investments out there. So maybe just so that people understand what it is that you offer from the get-go.
Okay, so let's as you say, set the platform. So what we have is a funding model where private individuals, guys like you and I, we can get access to the funding of residential projects. Traditionally it's for very high net worth individuals and institutional clients only to get into the space, whereas we make it accessible for investors from 100,000 Rand upwards, and they get fixed returns per annum based upon the investment into these projects, for funding these projects. What's quite useful to understand, Neil, is that as property investors, and Carlo would allude to this as well, is we traditionally look at property investment as coming in right at the end and buying the completed product and putting in a tenant and earning a yield or rental income based upon that tenant's performance. Whereas what we are doing, we actually giving the opportunity for investors to come in earlier in the value chain. So in the development phase, so they're becoming part of the value that gets extracted out of these projects, which is one unique aspect, I guess, of our model, is that early access. And then another part of it is, just to continue on that, is we tend to focus, well, the last 7 years or so, we focus only in the greater Cape Town area. We just felt rightly or wrongly, the fundamentals were better in Cape Town in terms of the local economy and property, and that served us well. So we've gone through multiple projects and iterations, performing quite nicely in these high demand areas. And the other thing I just want to mention one more aspect, which I think is critical, is that you get two types of property investor, I guess. You get the guy who wants to build assets, and he wants to own a whole lot of properties, and that's perfect. He's happy to delve into the market and deal with the maintenance and the tenant issues, etc., etc. We're offering something which is really for the guy who wants access to the property sector. He wants to get returns in the property sector, but he doesn't want to be in for the long-term haul of owning physical property. So I think we tick that box in terms of allowing people to have access to that, for sure.
Excellent. So it's almost like investing alongside the developer type of arrangement.
Yeah, in essence, exactly that.
Okay, wonderful. Okay, Nick, we're going to come back to you, and I think it's going to open up a lot of debate and questions as we move forward. Michelle, and I think, Michelle, you are a registered credit bureau in South Africa, and you service the education and property markets in South Africa. And I know that you come up with some fantastic stats in terms of the rental market, in the buy-to-let, and just really a picture of what's actually happening in that rental market. So maybe you can introduce, and I think your data is pretty much quite hot off the press, I must say. Well, there's no more presses. The presses are struggling, but certainly it's that data has just been released quite recently.
Neil, you are the press. We are hot off the press, loading live straight through you. Thank you.
Wonderful, fantastic. That's great. So now, what are you seeing currently in the rental market, Michelle? Because I'd really like to know what's the update and how recent this data is.
So I want to quickly share screen.
Oh, yeah.
And let's get the slideshow going. Right. Can everyone see okay? Fantastic. Yes. So this is Q1 and Q2 data, and I thought I'd share some of the good news stories that we're seeing at the moment. So the first good news story is that we're starting to see an improvement in rental payments behavior. And of course, Western Cape outperforming as always. So that's fabulous. You'll notice for those who haven't seen the data through the hard lockdown period, the blue bar is our national data set. So this is telling us how tenants perform nationally overall. And we plummeted down in that Q2 of hard lockdown. We only had 73% of tenants in good standing, dropping from 81.5% the previous quarter. But what we've started to see is that gradual improvement of payment profile quarter on quarter. Where we are at the moment, we've got 78% of tenants in good standing at the moment, and we're literally watching it every day, and we're seeing it grow every day. So we're hoping that maybe not by Q2, but by Q3, we might even be back into those 80% in good standing. But that's national. Of course, in the Western Cape, we're already back there. We're already at 82% of tenants in good standing, almost 83% of tenants in good standing in the Western Cape. And of course, Gauteng does lag behind, so only 76%. The good news story, though, is that we're going up. Let's look at, and I've brought this graph together looking at for Q1 again, I've put together the market strength index. So how do people perceive the market at the moment in terms of residential rentals? And what we have is we have this gray shaded area in the background, where in 2016 we had a market strength index of nearly 70%. And this is a market that's got a lot of tenant demand in the market, and that's dropped down. You'll see the numbers coming down from, I hope you didn't see the lights flash on and off. That was Eskom doing its load shedding power change with us. Thank God we're on Jenny, right? So we dropped down from 69% excess demand in 2016, and we've currently sitting at 44. So what does that tell us? Right now we have diminishing demand. We have a market where we have excess supply and not enough tenants that are looking. Why does that happen? Well, it's happened for a number of reasons. And one of those reasons, of course, as we've gone through this last 18-month period or 12-month period, is that we've had a lot of job losses. And as a result of the job losses, people losing their income, they're moving in with family and friends. And that, of course, has an impact on the amount of demand that's out there in the market at the moment. So with the diminishing demand, what we're seeing is we're seeing a shift in terms of vacancies. Vacancy rates having increased from 7% in 2016 all the way up to 13%. In fact, it was only 7.5% vacancy rates as we entered the hard lockdown period. So it has popped up. I'm going to show the good news stories, because right now on the graph it looks terrible. It looks like we're still continuing on that vein. My next slide is going to give us a little bit of good news. And then, of course, high vacancies, diminishing demand, the impact there is going to be on the escalation. So the escalations we're seeing at the moment is negative 0.2% at the moment. Good news, though, is it's stabilized. So again, I do believe that we may have hit the bottom. I do remind everyone that this is national. So this is all the data. We're not zoning in. And what we want to do, Nick, is we want to have a look at some of the areas that are performing well. So I do want to get to some performing, well-performing areas. So what do we have next? I just put this graph in to show the difference between an estate agent and a landlord perception out in the market. So the estate agent perception in the market indicates at 55 demand rating that they feel that there is a higher demand rating than what the landlord feels at 51, slightly higher. The estate agent feels that the supply of properties is a little less oversupplied than what a landlord feels. The estate agent at 63 supply rating, the landlord at 73 supply rating. And that might be that the estate agents are only servicing about 30% of the market. So they may not be feeling that the supply excess is quite as severe as what a landlord direct feels. But as a result of the estate agent feeling a high demand rating, their vacancy rates are low. So a estate agent managed property vacancy rate is currently sitting at 9.87%, and a landlord direct managed property, the vacancy rate currently sitting at 14%. And this may be because there's more foot traffic coming through the estate agent's doors than coming to a landlord direct, particularly if you are a micro landlord in the market at the moment. I felt that it was important to look at the vacancy rates in the different areas. So we looked at Gauteng because Gauteng services 50% of the tenant market, and you'll see that the current vacancy rate in Gauteng is 12.4%. This is good because last quarter it was nearly 14%. So we have seen an improvement in the Gauteng vacancy rates. Areas that are doing fabulously, as always, Centurion doing well, Tshwane doing well. I do worry about those two areas. We've seen Denel staff members only getting 20% of salaries, and we do know that Denel is in that region. So Tshwane in particular did incredibly well during the lockdown period, particularly in terms of rental good standing ratios, because it does service a lot of the government employees. So, and we know that our government employees did earn a salary throughout that period. Areas like Sandton, unfortunately, a lot of excess supply in the Sandton area, and it is a less affordable area. So the rents are higher, and we do know that the higher rents did suffer from higher vacancies than the more affordable areas. So what do we see in the Cape Town area and the Western Cape area? Western Cape overall, the vacancy rate sitting at 14.4%, and that has increased. So we have seen an increase in the vacancies in Western Cape. In Cape Town in particular, sitting at 28.8%. That's quite severe at the moment. And I do worry that that has a lot to do with the Airbnb market, still the short-term let market, etc. What we're seeing though in the northern suburbs, remaining so low, back down to that 5% at the moment. And of course, Wineland sitting at 9%. Escalations, we have a look at the escalations across the different rental brackets. As I mentioned earlier, the low end of the more affordable end of the market, not as severely impacted as the more luxury end of the market. So our below 3,000 Rand rentals still getting or achieving a 2% escalation. But we've seen that curve shift. If you look down at the bottom, that blue bar at the bottom, those are above 12,000 Rand rentals. And we were already hitting minus 2% escalation, negative escalation in Q4 of last year. And that has shifted to only 1.5%. I know it's still negative, but I am starting to see, and I'm quite excited by the fact that we're starting to see a move in the market over there. In terms of yields, what are we seeing at the moment? We're seeing overall our yields are sitting at, for sectional title, performing better than for full title, and this is not unusual. So we're sitting at just below 11% for our sectional title properties, and we're sitting at around about 8% for our full title properties. We know that the more affordable properties achieve a better yield. So our below 3,000, our 3,000 to 7,000 Rand properties are going to perform better and achieve a higher yield than the top end of the market, which are only achieving a 5% yield for those above 25,000 Rand properties. Which are the best yield performing properties from a sectional title perspective in terms of number of rooms? The 2 bedrooms are performing best. And this has been a shift in the last 12 to 18 months, where it used to be the 1 bedrooms. So it's good to see that the 2 bedrooms, and I do believe that that's because of this co-sharing requirement that we're seeing at the moment. So we've got our 2 bedroom sectional title properties performing exceptionally well. Let's talk about Durbanville and Bellville in particular. We know that the northern suburbs had a 5% vacancy rate. We know that Bellville and Durbanville both feature in the top 10 cities or suburbs in the Western Cape in terms of rent collections, both at 86% good standing ratio. So that is fantastic at the moment. And both sitting at around about 9% gross yield at the moment. From a Western Cape perspective, that's good, because Western Cape actually only sits at 8.6%. So both Durbanville and Bellville above what we would expect from the Western Cape as a whole. Compare that to Gauteng. Gauteng, we're sitting at a 10% yield, so Gauteng does achieve better yields, but of course collections is far worse. So you've got to collect your rent first in order to achieve your yield, and that of course you can do in the Western Cape.
Wonderful, Michelle. I think that's a great way just to set the whole scene. There's a pile of questions that have come through that we'll deal with a little bit later, but very interesting stats. And as to what the trends are actually happening there. Probably we've got to thank Gauteng, because a lot of Gautengers have moved to Cape Town. So maybe we've got to say that's partly driven, the success of the Cape Town market. I'm not quite sure, but it's just the thought that I'm putting in there. Carla, you're very quiet in your corner there. I just want to remind you that you're on mute. I can see you unmuted yourself there, Carla. And tell me and I'm going to open with a similar question as I asked Nick right at the start, being a really tough sort of year in a lot of sectors due to the pandemic. So tell us what your experience has been like, and what are you doing differently out there, in particular to the investors? What are you seeing out there?
Well, I think when you talk about rentals, you got to contextualize it with interest rates as well. because, you know, we look, certainly, you know, rentals have gone down, and I think largely sometimes have gone down more than Michelle's stats indicate. But, you know, we forget that, you know, interest repayments for the majority of South African property investors have gone down by 30% as a function of what, you know, the South African Reserve Bank did, as Nick mentioned earlier on. So in HFA, investors are not worse off, you know, than they were in the majority of the cases. The reality is that, you know, when the going gets tough, and the going has been tough, you know, the tough has to get going, which means that if you are a equally amateur, you know, property investor that don't have the right basics on how to find the right tenant and how to manage the right tenant, you have paid big fees to the University of Property Hard Knocks. There is no doubt about that. And, you know, Nick was mentioning earlier on about the great financial crisis. Personally, I tell you what, you know, I really built the majority of my local portfolio during the great financial crisis because I didn't have as many things I have now to take care of. So my biggest frustration as an individual property investor is that I had to take care of a lot of my assets in the last 12 months. And I just haven't had as much time as I wish I had to actually use this opportunity, because it's a massive opportunity. So for those out there that have 0 properties or 1 property, you should be hoping for this crisis to be actually lasting longer, to give you a better opportunity. You know, Ipsos, you know, like a market research, Ipsos says that South Africa, you know, there's a research called What Worries the World. South Africa is the second most pessimist country in the world. Can you believe it?
Wow. Wow.
And Neil, you're a little bit older than me, and I don't know how many negative, pessimistic people you know that have made money consistently. I don't know many, you know, and so, you know, we gotta look. We gotta look at, is it painful? Yes, it's painful. 99 was painful, 2007 was painful, but go back and ask those people that invested in property in 99, 2007, did they wish they had bought more? You can ask me. I wish I wasn't here in South Africa. I've been here since literally from 2000, but I wish I bought more in 2007, 2008 for sure. You know, so these are elements that, you know, I think people need to we so focus on short term, we forget that property is not a get rich quick scheme. You know, if that's a business, maybe one day you're going to start hosting Bitcoin workshops.
No,
but
not.
You know, it's a get wealthy for sure over a period of time. And I think it's fantastic to see how Nick is bringing a new asset class to the market. You know, different strokes for different folks. I'm the kind of person that likes to touch my properties, drive past them. But you know, there's different ways to sort of make money with property. So I think that hopefully just gives you a little bit of can I give you another stat? Because, you know,
yes, of course,
we forget these stats. You know, Minister Lindiwe Sizulu, you know, Minister of sort of housing or human settlements, share with us the other day that 12.5 million South Africans live in informal settlement. I want to repeat that. 12.5 million people live in informal settlements. And it's a fair assumption to say that some of their informal housing, you know, as they emancipate themselves financially, is going to become demand for entry-level housing. And I think, you know, like we touched upon. So there's a massive amount of pent-up demand. And, you know, the property market, again, has proved itself to be incredibly resilient. I was with Nick. I expected the market to drop. Then a number of factors came in, and we achieved 3.5% growth in this market. You know, like I'm also invested in the US. The US is pumping at 13%. Every time there's been a great crisis, a great financial crisis, the property market has always been the safe haven, and people have got back to it.
That's wonderful. I think, Carla, it's such a, you know, just to mention that whole positivity thing. I mean, I know personally you've actually had, you know, you were in Cape Town recently, you know, and you had a serious car accident. You're on your bicycle, and a car went into you, and you mentioned this whole mindset thing, and you're still so positive. And I mean, it's quite recent. You want to maybe just share that very quickly?
Well, you know, like I think Michelle is also like a cyclist. You know, we all gotta be safe out there. But you know, I have to tell you one thing. I have to tell you that I see massive opportunities in the Cape Town market, and I want to give a secret out to all the people that are like sort of like watching this webinar. And I certainly see massive opportunity in the Sea Point market, anywhere where tourism is being decimated. Go past, look through the next 6 to 12 months and look at, is tourism going to be a long-term play? Absolutely. Is Cape Town going to go anywhere? No. So, you know, I've been very negative about the property market in Cape Town, you know, through 2016, 2017 to say it had been overblown, you know, and I think to an extent it was. But the opportunities are there for those that have got the longevity, you know, to actually see past, you know, what's happening the next month, what's happening the next 3 months. So that's why I was there. I was cycling, but I was also busy investing. And maybe I was looking at properties instead of looking at the road. No, that's not the case. But yeah, Sea Point, that's one. Just don't go and buy my properties. But you know, like that's definitely a hack for everybody.
No, absolutely. No, I think that's some great advice, Carla. And I think, you know, you've raised such an important point. You know, I think we consume too much, you know, daily news, and there's a lot of negativity there. And I think it's going to sort itself out. You know, don't look at the macro aspects, look at the micro aspects that we're talking about here today. So, right, it brings us on to Nick over there. So, Nick, I just want to, there's a lot of questions coming in, by the way, guys, so we will deal with them at the end. And thank you, please, for you, the audience, keep flying through with those questions. We're going to have a long session on the Q&A. And so, Nick, I think it's important in any investment for investors to understand how the returns are generated. And above all, as they say, to always follow the money, meaning being able to understand the flow of capital. Can you maybe give us some insights on this pertaining to the structure that you actually employ, Nick?
Yeah, Neil, absolutely I can. Just to go back a step, and you talked about understanding the way investments are generated and following the money. Now, you know, one of the reasons I think people like buying property is it's tangible and it's understandable. So it's you know, if I take Carlo's business, for example, he's in the sort of buy-to-let coaching sector, and people understand it, which is why it's a big industry. And now with modern technology, I think investors want more and more transparency. They want to understand how investments work, because there are a hell of a lot of very convoluted investments out there. And if you ask a guy if he's invested in something, let's call it a traditional investment, maybe in the market, etc., and ask him to explain it, it might be difficult for them to do that. And I personally think, and I stand to be contradicted on this, I just think more and more people want to understand how their returns manifest, how they actually make their money. And you talk about follow the money. It almost sounds like an Italian could have said that, Carlo. Follow the money, you know. So I'd like to bring up a slide just to explain our structure in terms of the flow of funds, because I think that's part of the success of the structure is the fact that people do understand it and they can see how their returns manifest. So let me see if I can get the sharing right. Can you guys see that?
Yep.
Is it up? So, you know, it's the basic flow in our structure is pretty tangible in itself. You know, the investor, he pays his funds into the attorney's trust account first and foremost. That's the first place it goes to. And in there, while the funds are sitting in the attorney's trust account, it's actually having the benefit of a pretty good return. At the moment, it's 6.25% that they're earning. It is linked to the bank repo rate, which means it's going to fluctuate on occasion. Once the funds are ready to be deployed into the project, meaning that all the relevant securities in place, then the flow of funds are first checked by independent professionals who operate from a trust. They look at all the documentation, that is available, and they will then authorize the attorneys to pay the funds into the project itself for use. Now, the funds will only get paid out when the unit to which the investor is linked as part of his security is actually sold. And when that unit is sold and transferred to the end buyer, the attorneys will then pay out his capital plus interest. So if you follow that route nicely, it makes a perfect sequence. Funds are in the attorney's trust account. They move into the project, at which stage our investors start earning at 15 to 18% per annum once it's in the project. And then they cannot be repaid until a tangible property is sold and transferred and the attorneys pay their money back. I don't know if it gets much simpler than that. And I think that's a good reason why people enjoy this structure, because it is transparent and they understand exactly how the returns are generated.
Absolutely. I think transparency is critical. And so there's a pile of questions for you, Michelle. And, you know, what normally happens, you know, I find when there's a lot of data that's put on the table, we start getting people to say, well, what do you advise? And I think we got Carla, we got Michelle. But I think most important, Michelle, is that you're also a landlord, you're an investor yourself. So you also speak from your own experience and not only from your business experience. And I think that's critically important. And so Michelle, one of the questions is, as a landlord, should I give my vacant properties to an agent given their vacancy rates are lower?
You know, that is a fantastic question. And I'm just going to say that micro landlord, yes, I am. And I also sit on a listed REIT, and we look after 4,500 rental units in the affordable market. And this particular listed REIT has brought their property management in-house. So we're seeing a lot of the institutional landlords out there bringing their property management in-house and managing it themselves, as well as the opportunity to have an estate agent manage your portfolio on your behalf. And I guess it really depends on what you're looking for. So you could even have a hybrid of both options. And what do I mean by hybrid? You could outsource the securing and sourcing of your tenant to an estate agent. We are seeing that estate agents do have more foot traffic through the door, and they have a wider spread of tenants that they can present to your property. So you could outsource purely the sourcing of the tenant to an agent and then bring the management back in-house yourself if you want to collect the rent and perform the management component of that property portfolio. It also depends on your access to the property. So how close are you to your properties? How quickly can you take your tenants out to your properties? So it's not necessarily a one size fits all, and it's absolutely not, well, I'm going to outsource the whole process to an estate agent, or I'm going to retain the whole process in-house to myself.
Okay, I think that's some good advice there. Thanks, Michelle. And there's still a pile of questions. I want to get to the round table. We've got so many questions which are flying in at the moment that I want to try and deal with every one of them if we can. So Carlo, there's a question. You raised the whole thing about interest rates. And people are asking now for your views on this. And when do you expect interest rates to begin rising? And what strategies should investors put in place to manage the increasing loan payments? Quite a good question.
Well, I'm not an economist. I'll leave that to Sipa Mandla. I know he's a very revered guest of number of events. I know that in Europe, you know, it's been since 2007, they've been waiting for interest rates to go back up, and they haven't. In HFA, every time they go down lower. So, you know, I like to say that history doesn't repeat itself, but it rhymes. I think it's important that, you know, my best advice, don't fix interest rates. When you fix interest rates, all you're doing is you're making sure that you're making a loss. But at the same time, and that's one of the key things that caught out a lot of, call it, micro or small scale property investors in South Africa, is that, you know, most of them are not carrying enough cash reserves. You gotta carry cash reserves. You gotta carry between 3 and 6 months cash reserves of your operating cost of your property portfolio. That way, You can self-insure yourself against any change in interest rates, and you don't have to stress about it. That is a much better strategy. Don't go and fix interest rates, because that's financial suicide.
Okay, all right. So that's an interesting angle on that one. Thanks for that, Carla. I think
Neil,
some good. Yes, Nick.
I'd just like to jump in there, because it's a hell of a good point that Carla brought up about fixing interest rates. I think what people must remember, it sounds desirable to fix interest rates because one has a bit of, predictability about what you're going to pay every month. But what we mustn't forget is the big banks are not in the business of losing money, and they've got very smart people who determine what that fixed interest rate is going to be. So I agree 100% with Carlo. I don't think that's the way to go. I think it's good advice from him.
No, absolutely. And I also think that, you seem to be more in control. If you look at what the trends of interest rates over the last few years is that it's going to stay lower for a lot longer, I think. So the future prediction is very difficult to predict and then to make a decision like that. So I think great comment on that. So Nick, I'm going to keep you on there. There's a question from Winston, and it says, would you consider developments in the commercial and or industrial space? And if not, I'm just curious to know why not. So, I mean, I could probably answer that for you, but
I'm happy to answer.
I'll leave that to you.
Yeah, thanks, Winston. Nice question. So the reason for us is simple. So in fact, going back, let's wind back the clock 12, 13, 14 years. We'd been in the residential space for some time before when the global financial crisis hit. And in fact, funny enough, we were looking at moving into the commercial and industrial space. But we found out very quickly that the one thing that held strong during that time was rentals. I don't know if Michelle could attest to that, but certainly escalations wouldn't have gone up, etc. But in the middle income sector, properties remained tenanted. And that was when we had a bit of a light bulb moment to say, listen, residential property might not be as sexy in terms of returns as commercial, retail, or industrial, but it's got a solidity about it, especially in the middle income and low middle income sectors, because people need a place to live. So if they can't buy, they're going to be renting. So to answer the question is, we stick to residential. It's what we know. It's what our entire team knows. It's where we are. We'd like to think we've cut our teeth on all aspects of the residential sector, know it intimately, and I think that's where we offer people the best value.
Excellent. And I think it's also keeping focus. And I think also Carla raised the point a little bit earlier on in terms of the demand. And where's that demand? Using the informal developments. And, we want to give people title. We would love to give people title and everybody title in this country. And there's a lot of initiatives like the Kaya Lam in terms of giving people titles. So certainly, I would say residential is definitely where it's all happening. So
Neil,
can I give?
Yes, you want to add? I can see I've opened up a can. Yes, Carla, please.
Can I give one? Ladies first. Sorry, Michelle.
Okay, all right.
Okay, thank you. Thanks, Carla. Thanks, Jill. Also, just to add from a commercial perspective, what we're seeing in the market at the moment is we're seeing a lot of conversions. So we're seeing a lot of office conversions into residential, and this is because the market is there is an enormous amount of supply of commercial properties in the market. There are a lot of vacancies, and there's been a lot of construction in the commercial market leading up to this point. And as a result of those high vacancies, we're seeing a lot of commercial REITs converting those properties now into resi portfolio as well. So I think to enter an already overheated market with more commercial, where we have a need, to Nick's point, we have a need for residential accommodation. To Carlo's point, we have 12 million people in informal settlements at the moment. And the idea is to move people out of informal and into the formal market, housing market.
Excellent. Carlo, you want to add to that as well?
Well, yeah, another piece of information from, the General Household Survey in December 2020 from Stats SA, because, opinions are cheap, but data is real. In 2010, we had 2.8 million renters in South Africa. In 2020, we have 3.7 million. So that's a change of 900,000 extra renters in a decade. So you can continue to be negative, you can continue to be pessimistic, but that means that that market has grown by 33% in a decade. And that's where the opportunity is. And I truly expect that, you know, in 2030, if we're still blessed to be here, you know, that number is going to go up to 4.6, because, you know, what is happening, a lot of buy-to-let supply is being mopped out of the market, because a lot of buy-to-let investors are putting the properties back into the, call it, first-time buyers market. But then eventually it's like a coil that picks up pressure. And, you know, I can tell you in 3 to 5 years down the line, we're going to have a huge shortage of, call it, supply for buy-to-let, for those that are going to have the patience to navigate what is obviously a difficult, you know, spell into the cycle. People forget the cycle.
Great. Okay, thanks for that input. Nick, I want to bring you in over here. There's a question, and it's quite a tough one. And how many, we have seen many property developments not being successful, and in fact, some collapsing. So what happens to your investment in this case? So there's a suggestion that this could collapse. So how safe will it be to invest in opportunity private capital?
So Carlo, you might have to ask the questioner to adopt a bit of optimism from your side, not pessimism. But it's a very good question. So how we mitigate risk. Now, the thing is, I think people are very fond of touting probably a vague stat that property developments fail, which obviously they do. But you know that the vast majority of them actually are successful. Otherwise, people wouldn't be living in sectional title complexes. People wouldn't be living in houses, etc. So we need to understand that, you know, the bulk of property developments are actually successful. How we mitigate risk is a number of reasons. The first thing is we stick to our niche sector, and what that niche sector is, and again, I'm speaking for ourselves, nobody else, is that we focus on small to medium-sized complexes, because the bigger the project gets, the more complexity there is, and also the more negative cycles you might go through. So we stick to small to medium-sized complexes. We stick to an area we know. So we're dealing with municipalities we know. We're dealing with the market that we know. We're dealing with service providers that we know. So a lot of the unknowns are then taken out the equation, because we're keeping a relative consistency in terms of our performance. And the other thing that I think we've got right is, over the years, we've got to a stage where the entire value chain of the development cycle has input from us and controlled by us to some extent. And what that means is you're taking external factors and external role players out of the picture who might be a risk to a development project. So, you know, if the project fails, going back to the gentleman's question, we've got to ask ourselves is why would the project fail? So there are a number of reasons, but let's unpack these. Okay, the project could fail because the units don't sell. That's probably a pretty good reason, which is why we stick to high demand, middle income parts of Cape Town, because the demand is generally high, the appetite and absorption rate of buyers is high. And if you're paying attention to what Michelle's stats said earlier, where we are at the moment, the northern suburbs, it's got a hell of a low vacancy rate. I mean, 5% vacancy rates in current circumstances, rentals, is huge. And why I mention that is because even though we're in the development sector, rentals are what dictates to a large extent the performance of any given environment. So hence I mentioned that. Secondly, so that's the sales side. Secondly, we do it phase by phase. So we get the capital to build blocks, etc. We don't ever have unfinished units, which means that if something catastrophic would happen in the market, we could at least put tenants in, and then what would happen is that the investors would receive a lower return, but based on the income from a tenant. But the main thing is their capital would be safe because it's linked to the assets in the project.
If we had to use broad strokes, some of the developments that we've seen fail tend to be in the higher end of the market, which has really been struggling of recent times. So I think you mentioned that quite nicely there, Nick, in terms of the niche. So a general question, and this is to Carla, Michelle, and it's from Miguel. And it says, as people work more from home and being close to work is less of a requirement from tenants, what new location criteria should an investor currently use? So who wants to go first? Michelle, maybe you can, because you actually showed us some of the stats, and we saw interesting stats, what is happening in Cape Town, for example, and we see Sandton was at 26% vacancies, the highest of all. So people don't want to live in Sandton any longer by the looks of things. So maybe you want to give us your thoughts on that.
Well, I may start by saying it's not that people don't want to live in Sandton anymore. I just think that Sandton is quite an expensive area. And so demand does dry up in the top end of the market, and it kind of shifts down as people downscale. So we did a tenant survey prior to lockdown, and we did a tenant survey post-lockdown. And we asked our tenants, what are your needs? When you are going into the market and looking for property, what are your top 3 needs that you're wanting to be met? And we gave a range of 20 different options that tenants could choose from, ranging from, we want new appliances, we want a new unit and not a second-hand unit, we want free Wi-Fi, we want our deposit paid, we want first month's free rent. We put in all the tenant incentives that are out there at the moment. And of course, we asked what dictates. Is it price? Is it security? Is it distance to the shops, distance to work, or distance to a school? There were 20 different options. The tenants were very clear. The number one priority that needs to be met is price, affordability. And this has not changed from the previous year. In fact, it's gone higher. So my number one, as a tenant, my number one priority that I need met is pricing. My number 2 priority that I need met is safety. Again, this hasn't changed from the previous year. People need to feel secure and safe in their home. And the 3rd most important was distance to school, work, or the shops. And it depended on your age as a tenant as to which of those were more important. Our younger generation, distance to work is the most important. For our middle-aged tenants, distance to schools is most important. And for our older generation tenants who aren't working at the moment, the distance to the shop is the most important. And I hear that we are in an environment where there is a lot more work from home, but it's not a pure work from home environment. We still have majority a hybrid environment, and there still are tenants, predominantly tenants in the lower affordable end of the market, who will be needing to go to work. Their jobs are call center, their jobs are working in retail. These are people whose jobs require them more likely to be at the office than to be work from home. That having been said, so for us, post-lockdown, distance to work, distance to school, and distance to the shops is still the 3rd most important criteria that a tenant is looking for. And I imagine alongside that, for many of those who don't have cars, transport. So to be in a transport friendly environment close to the Rea Vaya or the Gautrain or whatever type of transport. And we didn't ask the question particularly, so this would be my gut feel here, that I think access to that type of transport would be quite important as well.
Excellent.
Neil, can I jump in for a sec?
Yes, of course, yeah. And
so Michelle, what you're saying is just also for my understanding, I think what you said makes a lot of sense. So for anyone listening who's or watching who is a budding asset builder, in other words, they want to buy properties, they want to get a portfolio of properties, what they actually need to look for is, based on that criteria that you're going, is where can they buy properties where the rentals are affordable? Where can they buy properties where people want safety? And that's what you mentioned earlier about sectional title properties. 2-bedroom units are becoming the more desirable, right, in the market, because it covers, I guess, those factors. So that's, I guess, Carla, for you as well, if you when you're educating your guys. I think that's a very good point, is chase what the tenant profile is rather than the property profile, if that makes any sense.
Carlo, do you want to add to that?
I think the question has been very well addressed by Michelle and Nick. So rather than repeating myself, I don't know if you have any other question that you wanted to sort of like ask me from the attendees.
Yes. Look, so I think, Carlo, we've reached the bewitching hour where we kind of have to start closing up. And there's a couple of questions which I'll throw you away and put it in your closing statement there, Nick, and also Michelle. But I think, Carlo, maybe you can give us your wrap up. Give us your 2 or 3 minutes wrap up. Leave people with something that they can walk away with and say, you know, this is what I can do. Give some guidance, give a direction. What they can take away from today's discussion.
Well, I think that, you know, there's definitely different ways to create wealth, you know, by investing in property in different aspects of the value chain in South Africa. You know, I think a lot of people want to develop, but don't have the skills to do it. And when you do it, you know, like, you're going to get into trouble. So, you know, I really like a couple of things that Nick mentioned. He talked about focus, and he talked about risk mitigation. And I think what he didn't specifically say is that I think they've got quite a solid construction capability, and they de-risk the project quite significantly. But I think the message is, you know, to believe in the supply and demand long-term fundamentals. I'm just going to leave with one a piece of data, because I'm a Gautenger. You know, I love investing in Gauteng. In 1996, census told us there were 7.3 million people in Gauteng. By 2016, there was 13.4 million people, an increase of 83%. Now, if that's not a booming market that you can tap into with the right knowledge, with the right tools, you know, with the right sort of community of like-minded people, then I don't know how and where you're going to make money. So that's my closing statement. Thank you so much for having me. And thank you, Nick, and thank you, Michelle, for the powerful knowledge that you've shared with the attendees today. Thank you.
Wonderful. It was great having you on, Carla, and wonderful having you always as a panelist. Your insights are as important. So, Michelle, we're going to get to you for your wrap up. I know there's 1 or 2 questions that weren't answered, like what local drivers should I look for to identify an early recovery in my market, and what areas are good in the southern suburbs. So, but yeah, and then there was also one around student accommodation. But maybe you can just sort of encompass everything in terms of what you have shared today, and leave our audience with something that they can say, I can use this.
Thankfully, Neil, I can multitask. So I saw the questions pop
I'm
up.
sure you can.
So I'm the female on the panel, right? So yes. I saw the George question come up. So the George question, we've got a 9.38% gross yield and an 82% collection rate. So George is performing really nicely. C point was mentioned. Unfortunately, the yield not looking fabulous at 6.28%, although the collection's good at 83%. In the southern suburbs, Claremont doing nicely from a collections perspective at 87% and Newlands at 86%, and both of those have yields at 6.8%. I thought I'd throw in Hout Bay and Muizenberg just for fun. So Hout Bay is sitting at an 82% collection rate, 7.67% yield, and Muizenberg collections at only 78%, although they have an 8.84% yield, which kind of speaks to the southern suburbs versus the northern suburbs. And you can see how much better the yields and the collections were in the northern suburbs. And just for fun, I did see that we had a question about KwaZulu-Natal, so I'm just going to throw it in as well for just to give broad information. Our best collections are in Port Shepstone. Our best yield is in Port Shepstone at 11.45%, eThekwini at 10.4%, Hillcrest at 10.7%, and Ballito only at 7.89%. Best collections in Port Shepstone at 91%. Nick, you may want to look at Port Shepstone. And Peter Maritzburg doing 86% collections and 10% yield. So that'll be my closing statement.
Excellent. No, thanks very much. It's great to hear those stats here, Michelle. Thank you for your contribution today. It's really been insightful. And your closing thoughts, Nick. You got the floor. And so Nick, I think there was a lot of questions, more technical questions pertaining to investing with Opportunity Private Capital. Maybe you can suggest that people can get in touch with you on that particular aspect, and maybe just give us your general wrap and your general closing comments and your thoughts on the way forward.
So firstly, I'm packing a surfboard and going to Port Shepstone, according to Michelle. And the second thing is I absolutely can't multitask. So I didn't see any of the questions coming through. In closing, I think it's important to mention this, is that property for literally centuries has been a real go-to for investment in certainly free market economies. And I think people get sucked into cycles, certainly negative cycles, and then they get negative about property. But I can say as an investment class, it's really stood the test of time. So I'd like to at least put that out there. Second of all, I think we've shown today that there are various methods of investing in property. One, of course, is those who are in for a longer term, which is buying the buy-to-let and building a portfolio, because as Carlos said, property is a long-term game. You cannot ask for short, high returns when you're actually buying physical property, which is where we come into that space where people can be in for, on average, call it, our average investment period is about 15 to 16 months. So it's a shorter period and they're earning high fixed returns on that. So at least they're getting exposure to the property market, even though they don't necessarily want to own a property. Then another important factor is you read a lot in various publications, not yours, I might say, Neil, is that,
Thank you.
that the property sector performs poorly, etc. And I think as a general comment, it's diabolical, because like anything, there are certain niches, there are certain areas of the economy that perform better, and property is no different. So for those guys who are investing in property, go and find those niches that are performing, because they will do well for you. Do not tar one general sector with the same brush. It just doesn't make sense to me, and I hope that message gets across to potential investors. In terms of our offering, the flow of funds and tracking your investment, as I explained, is quite basic. The complexity comes in the security we offer for investor capital. That's where it becomes quite technical, but vital, because that's our entire structure is predicated on the protection of investor capital. So we have a website, opportunity.co.za, so it's pretty easy to find. And our Cape Town number is 021 919 9944. That's 021 919 9944 if they want to get hold of us. And I want to thank Neil, first you guys at REI for hosting this, and Carla and Michelle, thanks. Nice to see you guys, and thanks for all your inputs.
Wonderful. So Nick Morgan, the co-founder, CEO of Opportunity Private Capital, Michelle Dickens, CEO and founder of TPN, Tenant Profile Network, and Carlo Mariani, founder of The Property Coach. It was wonderful having you today on the REI investment show. And to our audience, and I see there's been quite a few that have actually hung out over there. Thank you for holding on. And thank you for joining us, and join us next week. And in fact, there's a part 2, which is going to be on the 14th of July next month on this particular investment category. We hope you enjoyed it and you got value from these weekly webinars and from our panelists. And I encourage you to engage with all of them. And so we do have your details in terms of contact. There will be replays. So just a reminder that those who had to leave early could not access the webinar. You can see a recording, and it is available on either under shows on the REI Mag website, or you could go to our REI YouTube channel. But everybody who was registered today will receive a link. So any unanswered questions we will send through to the panel, and they'll be published in the Real Estate Investor Digimag or on the REMAG website. And if you have any new questions, you can post it then on info@remag.co.za. So just before you go, and I know some of you are looking at logging out, I just need to give you some important reminders. Our next webinars next week is our property management masterclass, and it's a 2-day one, and it's 3 hours. It's a marathon from 10 until 1 on Wednesday and 10 until 1 on Thursday. And you can earn CPD points. So if you're an agent, I would suggest, you be there. You can get 6 CPD points. It's a 2-day masterclass. It's brought to you by We Connect You, and it's a 6-hour event over 2 days. 12 different property experts, speakers, specialists on both days speaking on different topics. So please be there. There should be a link below to register. If not, go to the REI website under events, and you can click over there. So great incentive there. Then, of course, Tuesday, the 15th of June, it's our part 2 of our 12J investment series. That's also on the website where you can go for that. And then last, I must remind you about REI's 3rd annual Digitalization Virtual Summit. So it's going to be starting as a weekly series on Thursday, the 15th of July. And that's going to be 4 series before our big summit is going to be on Thursday, the 19th of August. And it's going to be South Africa's biggest PropTech and digitalization of real estate event. And this one really promises to be a big one. We are using groundbreaking new webinar technology never used before here in South Africa, and allows maximum opportunity to network, talk to speakers, and we welcome you all there. So watch out for those announcements. That will be in the next week or so on that particular one, or you can email us at info@remag. That's all coming. So I'd like to end up with some inspirational quotes, because we do need inspiration, as Carlo helped us so nicely earlier on. He said, progress always involves risk. You can steal second base and keep your foot on first. You can't steal second base. That's what you can't do. And that's from F.W. du P. And then Robert Schiller said, tough times don't last. People do. So just remember that. I know we are going through tough times. It hasn't been easy. And I'll say, stick it out. People can outdo tough times. So final words. Thank you once again, all. Thank you to Opportunity Private Capital, to Nick and his team for sponsoring. We'll be there for part 2, as I say, Wednesday, the 14th of July. And I want to thank you all for joining REI Talk Investment webinar today. We look forward to seeing you at our next masterclasses and webinars and our Digitalization Summit. So this is Neil Peterson of Real Estate Investor signing out. Stay safe and successful investing.